Welcome to Accountancy Academy. Today I discuss about double entry accounting system and basic rules. All profit oriented units and non-profit oriented units are following double entry system. A system that records twofold aspects of each transaction is called double entry system. Double entry system originates from dual aspect concept. According to this concept, it is assumed that each transaction has two aspects. For example, if a machine is purchased for cash, the transaction shall have two aspects. In one aspect, the amount of cash is reduced, and in other aspect, an asset in the name of a machine comes into the organization. Thus, if a system provides for recording the transaction in both of its aspects, it will be called double entry system. Before going to speak about double entry system, we have to know the meaning of the transaction. The word transaction indicates receiving and giving away. In case of any accounting unit, whether it is profit oriented or non-profit oriented, in that case, only that kind of giving away and receiving shall be regarded as transaction which can change the financial condition of the accounting unit. And the change of the financial condition of the unit should be measured in terms of money. Thus, giving away and receiving of love and affection, duty, etc. cannot be regarded as transaction, as the value received or given away cannot be measured in terms of money. In case of an accounting unit, whether it is an individual, business or non-profit seeking unit, only that receiving and giving away shall be regarded as transaction which can effect change its financial condition, measurable in terms of money. For example, payment of rent, salary, tax, interest, etc., taking loan, redeeming loan, receiving interest, selling goods, purchasing goods, etc., all can change the financial condition of the business, and each change can be measured in terms of money. Thus, a transaction may be defined as that act which alters the financial position of the accounting unit in any way, provided such alteration is measurable in terms of money. Now we see how a transaction is recorded in double entry system. In double entry system, at first stage, every transaction is recorded in the books of account, which is called journal, and such records are called journal entries. In double entry system, each transaction has two aspects and create double effects. Consequently, each transaction under double entry system shall be confined in at least two accounts, one of which gets debit and others get credit. The debit and credit of the transaction are of equal amount. For example, purchase a machine for ₹20,000. Here the transaction have two aspects. or two effects. One is machine is coming in the business, other is cash is going out or cash is reducing. Here the journal entry should be machine account debit to cash account credit. It is very important to discuss about rules for ascertaining debit and credit in a transaction. Before going to this discussion, we have to know the meaning of the word account, which has been used many times in our discussion. Account is a classified statement of transaction relating to a person, an asset, an income, an expense, a gain or loss. Here, a person includes an individual, a firm, or a company, such as bank are maintaining thousands of bank accounts, such as savings account, fixed deposit account, loan account, etc. At first, we discuss about golden rules for ascertaining debit and credit in a transaction. Before going to discuss about golden rule of ascertaining debit and credit, we have to know the classification of accounts. There are three types of accounts. Number one, personal account. Number two, real accounts. Number three, nominal accounts. Personal account has been stated that accounts relating to an individual, a firm, or a company. A personal account having debit balance in it represents debtor's account, and an account having credit balance in it represents creditor's account. Real accounts. Real accounts are accounts relating to asset, that is building account, machinery account, cash account, bank account, etc. A real account must always show debit balance because assets coming in are debited and assets going out are credited, and asset going out can never exceed asset coming in. Accounts relating to income, expense, gain and loss are nominal accounts. For example, salary account, interest receive account, discount receive account, bad debt account, etc. A nominal account, being account of expenses and losses, always show debit balance, and a nominal account being account of income and gains always show credit balance. There are some important accounts which will be discussed and explained later on. Now I speak about the golden rule for ascertaining debit and credit of a transaction. There are three rules for three classes of account as discussed earlier. Number one, for personal accounts, debit the receiver and credit the giver. Number two, for real accounts, debit what comes in and credit what goes out. Number three, for nominal accounts, debit expenses and losses and credit incomes and gains. By applying golden rules, debit credit of the following transactions are to be ascertained and journal entries are to be made. Number one, started business with cash rupees 5,000. Here cash is an asset and real account. So, as per golden rule, in case of real account, Debit what comes in and credit what goes out. Cash is coming here, so cash is debit. And credit capital account, as it is a personal account, gives it. Here cash has been invested in the business as a capital, so other aspect it may be considered as a capital, and capital is always liability of the business, so capital will be treated as credit. Now we record the transaction in journal. There are 5 columns in a journal: date, particulars, LF means ledger folio, amount debit and amount credit. So we write in journal: cash account debit to capital account rupees 5,000, debit 5,000, credit 5,000. Narration will be being the cash brought into business towards capital. Next, number 2, purchase goods for cash rupees 200. Here we see 2 aspects. One is expenses for purchasing good and other is cash going out. Here purchase is expense and all expense to be debited, and cash is going out. Cash is a real account and cash account will be credited as cash going out. So we write purchase account debit 200 and to cash account credit 200, and narration will be being the goods purchased in cash. Next, paid expenses cash rupees 50. In this transaction there are 2 aspects. One is expenses and other is cash is going out for payment. Here expenses is a nominal account, and as per golden rule all expenses will be debited, and cash is a real account, and asset, as per golden rule all asset what going out will be credited. So we write in journal expenses account debit rupees 50 to cash account rupees 50 credit, and narration will be being the expenses paid in cash. Number 4, purchase goods on credit from me rupees 300. Here we see 2 aspects. One is purchase as a expenses and nominal account, and all expenses will be debited, and other aspect is a mihit. Being a person, mihit is a personal account, and givers, as per golden rule, givers will be credited. So we write in journal purchase account debit rupees 300 and to meet account credit rupees 300, and narration will be being the goods purchased on credit from me. In case of purchase or sales on credit, the personal accounts are maintained, and where the purchase and sales are made in cash, the question of maintaining personal account does not arise. It is found in our area. A retailer notes the name of the customer whenever he sells the goods on credit. Similarly, whenever he purchases goods from the wholesaler on credit, then he maintains the accounts of the wholesalers. Next, number 5, sold goods for cash rupees 150. Here we see 2 aspects. One is sale of goods and other is cash is coming. Sale is a nominal account indicating income. As per golden rules, all incomes will be credited. So here sales account will be credited, Cash is an asset and real account. As per golden rule, cash will be debited because cash is coming in. So we write cash account debit to sales account. We write narration as being the goods sold in cash. Next, number 6, sold goods to Shamul on credit rupees 400. In this transaction, there are two aspects. One is sale, nominal account, and other is Shamul, a personal account. Here receiver, as per golden rule, receiver will be debit and other sale is a income nominal account. So sales account will be credit. So we write in the journal Shamul account debit rupees 400 and to sales account credit rupees 400. Action will be being the goods sold to Shamul on credit. Next, number 7, paid salary rupees 100 to the cashier. Here we see two aspects. One is expenses salary, nominal account. As per golden rule, all expenses to be debited, and other aspect cash and asset real account. As per golden rule, when the asset is going out, that will be credited. So we write in journal salary account debit rupees 100 and to cash account credit 100. Narration will be being the salary paid in cash. Next, number 8, depreciated building by rupees 50. Here we find two aspects. One is depreciation on building is a loss on building. So it is a nominal account. As per golden rule, all loss will be debited. Here depreciation account will be debited and other is building is an asset and real account. If the valuation of an asset increase, then it will be debited, and when the valuation of the asset decrease, then it will be credited. So here building account will be credited. So we write in the journal depreciation account debit to building account rupees 50 each. Narration will be being the building depreciated. Next, number 9, receive dividend rupees 75. Here you see two aspects. One is dividend is coming on income, and as per golden rule, all income will be credited. And other aspect is cash is coming, a real account. So cash will be debit and dividend account will be credited for rupees 75. Narration will be being the dividend received in cash. Next, number 10, receive rupees 200 from Shamul on account. In this transaction, two aspects are found. One is cash and asset and real account is coming. When the asset is coming, that will be debit, and other is Shamul, a personal account, is a giver. As per golden rule, giver should be credited. So we write in the journal cash account debit to Shamul account credit rupees 200 each. Narration will be being the cash received from Shamul. Today I don't want to continue discussion further as this video becomes long. In my next video, I shall discuss about rules applicable in case of accounting equation and journal entries and ledger posting. I wish all of you good luck and success.